hit it.
It's Tuesday, June 13th, 2023, episode 215. I'm Patrick Ceresna.
And I'm Kevin Muir. This week we have an off-schedule show, but we wanted to get one in before summer holidays makes it tougher. We have Macro Alf in the house to talk about liquidity, his investment process, and proper pizza etiquette when you are in Naples. Then it's time for Patrick's Talking Charts, where we hear from the Lord of the Crayons himself and find out what he thinks about the recent market action.
We end with a no stupid questions and skin in the game, and folks, we might even drink some beers along the way. Lena, hop on here. What beer am I drinking this week?
So today Patrick is drinking Corazon de Malta English Pale Ale.
Well, it's, let me just try it out.
It says a classic English style and beautiful amber color. Excellent balance between its caramel malts and a low aroma of English hops with floral notes and earthy character. I don't know what that tells me about the beer.
It actually is a really nice beer.
Actually, I was looking at that, Patrick, and I was thinking I would like one of those.
Yeah.
Make sure you bring me back one of those.
All right. No problem, buddy.
All right, let's do side effects. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much Huddle may include the chlamydia shorts, the long bond coma, and the widening breath hypertension.
Ooh, I've had that one.
They seem, our listeners love to put chlamydia in the side effects.
It is.
I don't know. I'm hoping
it happens to a lot of our listeners.
A lot of experience. All right, let's get to the interview with Macro Alf. It's our great pleasure to welcome back to the show Macro Alf. I'm not even going to try to say your last name, Macro Alf, because the last time I did, I butchered it and made such a mess that I never lived it down. Thanks for coming back.
Hey, Kevin, always a pleasure to be here. And, you know, you'll not be the first or the last one to butcher my surname. Fair enough. I butcher the English language every day. I mean, come on. It's fair.
I get it as well. Just because you have like an old Scottish name, I get people saying Weir and all sorts of stuff. So I understand how it feels. So listen, we got a lot to talk about. First of all, since we've spoken last, you've no longer worked for the big bad bureaucracy and you've gone off on your own. Why don't you just tell people what you're doing and like your product and kind of just give us the elevator pitch?
Let's do that. So I used to work for ING Bank. It's a very large global bank based in Europe. And I run institutional portfolios for them for a while. And then at the end of 2021, I decided that I wanted to do something else and namely be able to speak to Kevin on this podcast. No, I'm joking, but namely be able to share my views with the world, which, you know, when you run a large portfolio in a large institution, it's just not possible. And I started my own company. It's called the Macro Compass. And what it does is it tries to break down macro and markets in plain English, using a bit of the experience and the mistakes I've accumulated running a pot of money, and using my data-driven approach to macro in general, and also trying to be actionable. You know, what we mostly miss here, Kevin, I think you do that very well, is trying to couple analysis with the trade idea. And if you're wrong, you're wrong. I mean, right. And I think people are just too afraid to be wrong. And well, I try not to be afraid.
That's actually true. I completely agree with that. And I always say that Stanley Druckenmiller talks about how he gets 60% of his trades right, which means he gets 40% wrong. And I'm no Stanley Druckenmiller, so that means I'm going to get at least 40% wrong. And really what I always view my kind of value add is ideas, just something to think about things differently. Maybe it sparks something you trade. And not only that, trading is all depending on your own risk tolerance. And nobody can handhold it for you. You have to decide where you're going to sell and buy and stuff like that. But let's not get too much into the philosophical nature of trading. Let's talk about the markets. First thing I want to approach is liquidity. Lots of talk about the TGA, about QT, all the new programs. Why don't we kind of jump in there? And while you're doing it, just could you make sure you explain, like, if you're going to talk about the TGA, tell people what it is, how it works, why it's important.
Okay. So the narrative out there has been that as the government needs to issue bonds, more precisely T-bills first, to refill the Treasury General account, it would drain quote-unquote liquidity from quote-unquote the system.
Right. So why don't we just jump to 1 second? Why would they have to refill the TGA, and what is it?
So the Treasury General Account is the account that the government of the United States owns at the Federal Reserve. It's basically like the checking account of the government at the Fed. And normally the government of the United States has a bit of a cash buffer, effectively deposited at the Fed, which is called Treasury General Account, which generally runs in the few hundreds of billions. Kevin, but because we were approaching the debt ceiling over the last few months and we didn't have a deal to come across that hurdle, well, the government couldn't issue any more bonds. They couldn't incur in any more debt. So what they needed to do is to drain down that Treasury General Account, effectively taking money from the Fed to service their normal spending, be it deficit spending or be it just spending from the government, paying their employees. So they drew it down to very dangerous levels, basically very close to zero. But now that we have a deal on the debt ceiling, we need to rebuild that buffer up to more comfortable levels. So that's what it means to rebuild the Treasury General Account.
Okay. And so we have a situation where the government is planning to issue $500 or $600 billion of T-bills mostly over the next couple of months. And the thinking is out on Wall Street and Bay Street and whatever street, I guess the city in London and all the financial centers throughout the world, is that this is going to cause a liquidity drain. And you have a different feeling and or approach. And what is that?
So let's talk about the mechanics for which this would ever be linked to anything called liquidity. So the story goes as follows. When the government spends money in the real economy, so it does deficit spending, it basically adds net worth to the private sector. If they cut your taxes, you all of a sudden have more money to spend. And then the government goes out and issues bonds to quote unquote fund that spending. And we don't talk about that deficit spending funded by bond issuance as liquidity drainage at all. But now that instead the government has to issue bonds just to replenish the Treasury General Account rather than spending the money in the real economy, people, of course, are talking about this as a liquidity drainage. And for liquidity, Kevin, what they really mean is the amount of bank reserves in the financial system. That's what they mean by liquidity. So how the story goes is, if the government is issuing bonds and primary dealers are buying these bonds that the government issues, but the government isn't spending the money into the real economy, but rather just locking it up at the Treasury General Account at the Fed, the primary dealers need effectively to use reserves to absorb these bonds without getting any new fresh resources from government spending at all. So you basically have to use existing resources to absorb new bond issuance. And so bank reserves generally take the hit. And one item on the liability side of the Federal Reserve, that's the Treasury General Account, gets replenished. And the offsetting item that moves down is bank reserves, another liability of the Federal Reserve. Now, bank reserves are often identified as liquidity for the financial system. And I think there is a couple of things we need to discuss about that first, and a couple of options under which replenishing the Treasury General Account does not lower the amount of bank reserves in the system in the first place.
All right. So what are they?
So let's talk about how an option for which refilling the Treasury General Account does not drain liquidity from the system in the first place. We discussed about primary dealers or banks or maybe a pension fund or you or I having to buy all these T-bills that are hitting the market all of a sudden. What if instead money market funds step up and buy these T-bills? After all, a money market fund is there to buy T-bills. It's their mandate in the first place. They have about $2 trillion locked at the reserve repo facility at the Fed. So that's another liability of the Federal Reserve balance sheet, which could be reduced to accommodate the increase in the Treasury General Account. So $2 trillion is quite a lot of dry powder. And money market funds effectively look at a couple of options they have today. They can invest the cash they're getting just by parking it at the Fed at the reserve repo, or they can buy T-bills. If you look at where T-bills are trading today, they are trading at or just above the levels that they can get in the reserve repo. So from an incentive scheme perspective, from an yield attractiveness perspective, you might want to make a case, Kevin, that some of the money will be coming from money market funds. So that's already the first deterrent. The one-on-one relationship for which bank reserves move down by the same amount of bonds issued to replenish the TGA does not take into account that this could be sterilized by money from the reserve repo facility.
Let's just jump in there and make sure that everyone understands this, because it's this reverse repo account has become an albatross. Like it's monstrous, as you mentioned. It's a couple trillion, and it is making it more difficult for folks to understand liquidity. And it's not only that, the Fed doesn't control how big it is. It's completely by demand, and it's generally just an overnight kind of thing. So therefore, that liquidity can come in and out of it at any time. So first of all, why don't you explain to people what the reverse repo account is, like specifically?
Yeah, Kevin. So I think it's important we take a step back and talk about the demand for T-bills. It's going to fit into the picture later on anyway when we talk about liquidity. But when it comes to the reserve repo facility, the reason why it exists, it's in the first place because there are a lot of institutional accounts out there that they don't have access to the Federal Reserve. It's mostly actually banks that have an account with the Fed directly and can deposit money straight away at the Fed. But for most large asset manager and institution out there, that's not true. Corporate treasurers, asset manager pension funds, and even money market funds generally don't have access to the Federal Reserve. Now, the reserve repo facility was basically created when rates were at zero to make sure that the very large demand for T-bills wouldn't push the yields on these T-bills actually into negative territory. I know this sounds like, 300 years ago now, but back then, a couple of years ago, we had this problem. So the Federal Reserve effectively created a facility for money market funds where to basically redirect their pent-up demand for T-bills away from T-bills to make sure that T-bill yields remained close to the zero lower bound and not into negative and didn't go into negative yield territory.
Right. It was so the Federal Reserve could provide a floor to ensure that rates did not go below their set bottom end of the range.
That is correct. And now fast forward to today, when risk-free rates or federal funds rates basically are 5%, and most banks out there are not offering the same amount of overnight deposit rates at all. We're actually very close to 0% levels for most banks. You obviously have more people that are choosing to redirect their money away from the banking system into the money market fund industry to try and capture these very elevated T-bill rates or reserve repo facility rates that are closer to 5%. So now the reverse repo facility has grown to be over $2 trillion. But at this point, because these money market funds don't really have T-bills to invest in, they've been starved effectively from good yielding T-bills for a while. The moment that the government has to start issuing these 500, 600 billion T-bills, people only look at the supply side of the story. But money market funds out there are actually starving for T-bills.
Right.
So they
before
might want to redirect.
Before we go there, could you explain to people what a reverse repo is, like the actual dynamics of how it works and what's occurring?
Yeah, it's a good question. So think you are a corporate treasurer, okay, and you're working for Google or Apple, and you're sitting on a bazillion of cash. I think these companies have tens of billions of cash on balance sheet. And so what do you do, Kev? I mean, you can just deposit this money at a bunch of banks, right? And then it works okay as long as there is no problem, but you don't get rewarded anything for it. You get your 0%, your 10 basis point, you get nothing out of it. So at some point you think about something else and you're like, what if I actually give away this cash against basically I make a collateralized loan where I lend this cash backed by a treasury as a collateral. So you give the cash to somebody who owns treasuries and he will lend you the treasuries against the cash you have given him. So it's just the opposite of a repo transaction. In a repo transaction, you have the treasury bond, you lend it away, right, in a repo, and you get the cash back. Here instead, you have the cash, you lend it, and you make a secured collateralized transaction where the treasury that somebody else's own is actually the collateral. And this is a much safer way to own your cash.
Right.
Because
but in this case, it's actually the Federal Reserve. And if, like, just to clarify, they take a bond, they sell it to, generally, they still need to be approved participants. So they're mutual funds and things, companies of that nature. They sell them a bond and they promise to buy it back tomorrow or a week later at a specified price. And the difference between that is the interest rate.
That is correct.
Got it?
And that interest rate ends up being much higher than the 0% that the corporate treasurer, or in this case, the money market fund, would otherwise earn. So the reverse repo market exists basically to accommodate transactions between entities that have a lot of cash at disposal but don't want to take overnight unsecured risk at a bank. And we have seen what happens, Kevin, in March. If you take too much of that unsecured banking risk, you're not rewarded for it because basically you don't get paid to take that risk. But if something goes bad, then especially if you have money above the FDIC insurance limit, you get hit.
Right. So in this case, sorry to interrupt, Alf. I just want to say one last thing here in terms of you mentioned how the reverse repo program at the Fed was born when it was to stop interest rates from going below zero. But now in this ample reserve system that we're in, it's actually used to ensure that interest rates at the front end of the curve don't fall below the bottom end of their floor.
Yes, that is correct.
Okay.
And now obviously, if you provide money market funds with the usual outlay for their investments, which is T-bills, they might want to take some money away from the reserve repo facility and invest in T-bills. Now, money market funds are just one of the many institutions out there that have normal excess demand for U.S. collateral for T-bills. I mean, I discussed about Apple Treasury, Google Treasury. These guys don't want to have overnight unsecured risk by depositing their money at a large bank. If they can, they prefer earning a higher interest rate, which T-bills provide and will keep providing compared to bank deposits, while at the same time taking less risks, because their investment is not the unsecured liability of a bank, but it's the liability of the U.S. government, which you might want to argue it's much safer than parking money at a bank in an unsecured fashion. Together with them, you'll have you'll have pension fund managers and asset managers and so on and so forth. FX reserve managers, Kevin, another large cohort of people that actually, sell their goods and services. You're a Brazilian corporate, you sell your soybeans, they're denominated in dollars, you get paid dollars, and these dollars enter the Brazilian banking system, which ultimately means they end up on the Brazilian central bank balance sheet. And the Bank of Brazil will be looking for ways to deploy these dollars in a safe, liquid, and deep market. Well, guess what that market is? It's T-bills, it's short-term treasuries. So there is a very large pent-up demand for this upcoming supply, and people are very focused on the supply side of things. But what about the demand?
Right. And the key to this is understanding that, in essence, the money that's gone into the reverse repo has already been withdrawn from the system. So if the T-bill, if we think about this, if the TGA was increased by $600 billion, and at the same time the RRP were to be declined by $600 billion, meaning the people that were investing at the Fed just took it and bought T-bills, then there would be no change in the liquidity of the system. Have I got that right?
That is so right.
Yeah.
And now we have to talk about whether bank reserves are liquidity, because the mechanism here that, Kevin, that many people are drawing is that by reducing the amount of bank reserves in the system, you would hit the stock market. Okay, so what people like to do is they draw two lines, and generally speaking, those are long-term charts, so they go all the way back to 2010, and they draw a line of bank reserves that goes up over time. That's basically like very well correlated with the Federal Reserve balance sheet. So the more the Fed did quantitative easing, the more reserves there were in the system over time. And so the Fed balance sheet became bigger, and equity markets went up over the last 10 to 12 years. And if you draw these two lines on a chart, they look so well correlated. So people like to extrapolate that changes in bank reserves tend to drive changes in equity prices. Okay, I'll give you first the geeky answer here to the question. If you run a very simple linear regression and you say, okay, let me look at the changes in bank reserves against the changes in equity prices. So I'm trying to predict basically whether the changes in bank reserves have a predictive power for equity market returns. And I apply a lag, of 3 months or 6 months to try to see whether I get an early indicator, which is statistically significant. The amount of S&P 500 returns that is explained solely by the change in bank reserves is 3%. 3%, Kevin. So this is the variability of returns in the S&P 500, which is explained by changes in bank reserves, taking a lead time of 3 months, 6 months, 9 months, 12 months. You can play around with all the transformations. Kevin, does it surprise you if I tell you you cannot predict equity market returns by looking at one variable that is freely available on the Fred website? It doesn't surprise me.
There's more to equity analysis than just guessing the total liquidity in the system?
Yes, Kevin, there is. So let's talk about the mechanics. Why is it not the case that more bank reserves or less bank reserves mean automatically higher equity prices or lower equity prices? Well, it's pretty simple. Banks cannot and will not use reserves to buy stocks. It's not like if there are more bank reserves in the system, then JP Morgan will go around and buy all the Apple shares in the market and they will push the S&P 500 higher. So bank reserves are not used by banks to buy assets, are not used by banks to make loans. Bank reserves are used by banks to settle transactions in the interbank financial system. It's basically like having a coin that is dedicated and ring-fenced for US banks. So JP Morgan and Wells Fargo can settle transactions between each other using bank reserves. But it is a ring-fence system, Kevin. These reserves cannot get out of the financial system, let alone they cannot be used to purchase stocks by banks. So this pipe that people like to draw between bank reserves and loans or equity prices is an imaginary pipe. It doesn't exist. And that's what people actually fail to appreciate, I think.
Okay, so lot to unpack there. I want to start, though, with a comment that you made that I'm sure is going to cause a lot of people to just their minds to be blown. I happen to agree with it, but I think you should explain it. You said the banks don't lend out reserves. And most people think that a bank takes in money from people and then lends it out, and that's how it operates. And it's there's obviously there's more to it than that. But at the end of the day, if you believe that the banks lend out reserves, you'll come to some conclusions that I think will be incorrect. And it has to do with exogenous versus endogenous money. Why don't you tell people your version of why you think the banks don't lend out reserves?
I think this is one of the most important concepts in macro, which is widely misunderstood. And if you don't really understand money, it's very hard, I think, to piece the puzzle together. So there is a very famous paper from the Bank of England itself from 2014 that shows the very simple mechanics behind bank lending. And firsthand, I can also tell you by having worked for a bank for a very long time, that when a bank has to make a loan, Kevin, there is nobody that is checking at that very same time how many deposits or how many reserves the bank has.
Right.
In the checklist, when making a loan, there is nobody that goes and checks how much deposits and reserves are out there. Why? Because in the pure mechanics of making a loan, a bank doesn't need the reserves to produce the loan. It needs, obviously, a minimum amount of reserves, a prudent amount of reserves on the balance sheet to settle the overnight transactions with other banks, but it doesn't necessarily need the reserves to make the loan. So when a bank makes a loan, what it needs to check, and it usually checks, are basically three things. It's the creditworthiness of the client, of the borrower. Is it going to pay me back? is the loan yield, so what is basically the risk reward in my loan transaction, and it's the return on equity. The most important part is the return on equity. So the bank will be looking at how much capital it needs to attach to that loan from a regulatory standpoint, and it will be looking at potential returns it can make, effectively extrapolating what is the return on capital that they can make on that loan. If those three items are matched and are checklist and they are, they get green light basically to go ahead, they will make a loan. How many deposits, how many reserves doesn't really matter. And that's because mechanically, when a bank makes a loan, it increases its asset side. The entire banking system, let's say, if assume that you have a system with one bank, let's make this example very easy. If in the system there is only one bank, you'll make a loan, you'll create credit, you'll create a new bank deposit that is now owned by Kevin, that has taken on a loan to buy a car. Kevin will take the newly created money that didn't exist before, will go and buy a car from somebody else, and that somebody else will now have Kevin's newly created money instead of the car, and that money will end up where? Again, in the banking system. So the original bank, one bank credit system we have described, has now an additional asset, which is the new loan to buy the car, and will have an additional deposit, which is ultimately the more bank deposits the guy has, the guy who has sold the car to Kevin. So you have to think of the entire bank balance sheet as expanding with new loans and new deposits every time a new loan or a new mortgage is made.
Right. And this is why so many people had trouble with quantitative easing. When quantitative easing happened, everyone looked at the amount of reserves that were being created when the Federal Reserve bought bonds and put out cash into the system. And they said, oh, look at all these reserves. It's going to flood the system and it's going to create all this inflation. And yet I always said, when I was trying to explain to folks why quantitative easing doesn't cause inflation, if you think about, like JP Morgan, if Jamie Dimon sells $1 billion of bonds to the Federal Reserve, they're going to have $1 billion less of bonds and they're going to have $1 billion more of cash. That's not going to make them any more or less likely to make a loan for all the reasons you mentioned. That at the end of the day, that's created by the demand for loans, the levels, and then also JP Morgan's balance sheet in terms of equity. And this is kind of an important thing. And I think too often folks are living in that old environment where we were in a reserve constrained system. And the government did control the speed upon which loans were created by withdrawing reserves and putting them back out, but that's no longer the case.
Indeed, that's no longer the case. And look, you can make other examples to disprove the wrong thesis that banks multiply reserves away, basically, when they make loans. In Japan, which has actually been there decades before us, the Bank of Japan, after the real estate deleveraging crisis of the 1990s, started basically with quantitative easing exercises, of any sorts. Those increased the amount of bank reserves in the system pretty dramatically in Japan. If you now look at what happened in Japan in between the mid-90s and, let's say, today, you very often see cases where the amount of bank reserves in the system in Japan went through the roof, and yet the amount of bank loans actually shrank at the same time, Kevin. It didn't even kept, flat. It literally shrank. So banks, even having a lot more reserves than before, didn't even renew the existing loans once they rolled over. They actually decided to shrink their loan books. The other example you can draw is in 2019, for instance, in the US, you had still ongoing quantitative tightening between 2018 and 2019. So the amount of reserves in the system went down because the Fed was doing quantitative tightening. You go and check bank loans in the US between the beginning of 2018 and the beginning of 2019, and you'll see that they went up. So banks having less reserves were making more loans. Again, there is no correlation between the amount of reserves in the system and how much banks will lend. Banks will lend if it makes sense for them to lend. And banks are there to make money. commensurate to the amount of risk they take. So they're going to be looking at the demand for loans out there, coming from whom is the credit worthiness good enough, and is the return on equity they can make on making these loans solid enough to justify taking the risk. That's it. Banks don't use reserves to make loans.
So I think we've established that quantitative easing doesn't cause inflation, yet here we are kind of 2 years into one of the biggest inflation spikes that we've seen in ages. First of all, what do you think caused it? And then let's talk about, after you explain what you think caused it, how you think it's going to evolve from here.
The real money printing caused it, Kevin, which is a combination, almost unprecedented at the same time, I would say, of massive fiscal spending to the tune of several $1 trillion in the US alone, coupled at the same time with several $1 trillion in the Eurozone and everywhere else you were looking at. Fiscal spending, big times fiscal spending in 2020 and beginning of 2021, coupled with government guaranteed bank lending. So banks were basically told you can lend out and the government is going to take most of your credit risk on board. That effectively led the real economy money printer, which is the government through fiscal deficits and the banks through making loans, to generate a large amount of real economy money. And the way I like to track this is by basically splitting the two forms of money. Financial money creation, and that's the amount of bank reserves, that's what we have discussed so far, and real economy money creation. So I've created an index, which is called the Macro Compass Global Credit Impulse. And what it does is it looks at how much real economy spendable money households and corporates are getting at any point in time. And if you look at the 5 largest economies in the world, between 2020 and the beginning of 2021, we have increased the amount of spendable real economy money in a very, very rapid fashion. So effectively, you give people more money to spend on services and goods, real economy money, not money stuck in the financial system. So you wait for a bit, you reopen the economies, and then all of a sudden you get a huge amount of aggregate demand coming through. And then it also coincided with supply bottlenecks and the war and everything we know. But really, the amount of real economy money printing was outsized, Kevin. And that's how we got there in the first place.
Yeah, I don't think enough people understand the response to COVID. And they look at they look at the financial money printing, as you call it, and they go, well, the great financial crisis, we did all this QE and stuff, and yet we didn't have any inflation. And yet this time we had all this inflation, but this was so much different. The government was mailing checks and spending money into existence, whereas in the previous case, in the great financial crisis, they were actually cutting back on their spending and reducing it because, the change in attitude about deficits. I would love to know if you think that this change in terms of what we can expect going forward in terms of government spending money into existence, is this a permanent shift, or was this just something that we saw once and we're going to be back to the Tea Party days of sequestration and the government's cutting back and trying to balance budgets?
This is, I think, the most important question for macro investors over the next 5 to 10 years. I think we should expect, especially in the US, quite a relevant shift towards a broader acceptance of government deficits. And I think it's also, Kevin, because the electorate is going to change. By 2028, most of the voters in the US are not going to be boomers or Gen X anymore, are actually going to be more and more people that are younger than 40 years old, basically. And
you guys are going to take over on us, Alf.
Yes, pretty much. And no, look, the problem there is that, of course, if you were an asset owner, you didn't really want to see inflation out of control, right, Kevin? I mean, you wanted this very controlled financial repression kind of world, right, where you had Goldilocks kind of situations with low predictable levels of growth and inflation, and central banks were always there to back you up. And, it was all about cheap credit. And if you were an asset owner early enough, you were made a millionaire just by owning a house. I mean, you didn't even have to be a genius. You didn't even have to have a global diversified portfolio. If you were in Canada or in the US, you bought a house with a mortgage, and 10 years later, you were a millionaire. And you don't want any change to this system, right? You don't want that. And fiscal deficits can be scary, right? Because especially, these asset owners, most of them have lived through the 80s. They know that inflation can generate turbulence in macro conditions, and it can also produce, through the monetary policy response, it can produce years and years of flat or negative real returns on your assets. And you don't want that, Kevin. So you are going to oppose any vicious change to the system. But now, if you're a 30 years old guy, which owns very little assets, and you have gone through the pandemic, and you have seen that the government can mail, checks to you, and yeah, you've got some inflation, but at the same time, you've also got salary increases.
Yeah.
The job market has become much tighter, Kev. You can change your job and you can get a higher salary. And you start wondering, how can I make up some wealth here? Maybe I can make it up through that. So I think the opposition, the political opposition to deficit spending will be much lower than in the previous decade, simply because that's what the voters will want to see.
You know who I follow and think is so smart on this topic is Marco Papich from Clock Tower. And he talks about the median voter. And he just keeps hammering it back that the median voter is okay with deficits. And I think all you have to do is look at this budget deal that was the debt ceiling deal. And you realize that, yeah, sure, the Republicans, squawked about some things, but it wasn't like they went to the wall and stopped the spending. We're still, these are still monster numbers that they're putting out there. They're trying to claim it's a win by, saying that they reduced a little bit, but they didn't really reduce anything. And contrast that to 2008 under the Obama administration, when the Tea Party was under control, and yet they had to, here we were facing the greatest private sector credit crunch that we've ever experienced. And what did the government do? The government retrenched their spending. Anyway, so I'm with you. I completely, and I agree that it's going to fall down on generational lines. And I don't think enough people understand that as the younger people come, they're going to be more and more okay with it. And I always say, instead of sitting around discussing which one is the moral high ground, like which one's right, who cares which one's right? Why don't you just figure out which one's going to win? And, and if that's the one that's going to decide that's going to win, go with it. So by that kind of analysis, I'm assuming that you think inflation's here to stay?
Yes, I think we should discuss about inflation in this cycle and the new trend in inflation. Those are two different things. And I have learned by making many mistakes and losing money that you shouldn't confuse cycles with trends. So here we're discussing a trend in inflation, Kevin, a long-term trend, right? And basically we're saying, look, because of more money that will be spent into existence more structurally by governments, you should expect more inflationary pressures. And you should couple to that some other drivers, right? You should say, look, the globalization that we have seen over the last 10 years might actually take a little bit of a breather. Look, the Chinese workforce will shrink by 600, 700 million people. That's a huge number over the next few decades. So basically the cheap supply of labor and the globalization efforts that caused structural disinflation tailwinds will recede over the next few decades, on the margin at least. And you can add at least a couple of other drivers behind your story that, structurally speaking, inflation won't average 1.5% like it did for the last 10, 15 years in the US, but maybe it will average 3, maybe a bit more. But anyway, there are reasons to believe that, structurally speaking, the trend in inflation might be higher than it was over the last decade. Said that, Kevin, there is a cycle. So if you're an investor, a macro investor, you can have a long-term thesis. It's going to be very hard to stick to that thesis if the cycle disproves or goes against the trend. And this is where we stand right now, I think. I mean, we're recording on the 13th of June. We just got the CPI print. And yeah, I mean, I laugh a little bit at Powell's definition of, his preferred measure of inflation is core services X housing. So I'm basically stripping away food, gas, oil, goods, housing, maybe something else I'm forgetting. And as somebody always says, if you take inflation out of inflation, then inflation will be zero. But apart from this joke, he likes to look at this component because studies show that it is the component most linked to wage growth and slack in the labor market and slack in the economy. So if we follow what Powell is following, and as my friend Jim Leitner always says, listen to the game master. So let's use the same pair of glasses that Powell is looking at. You see that core services X housing is trending at about 3% right now. This number used to be 6.5% in October last year. And so all of a sudden, Powell was trying to sound a lot like Volcker. He was trying to make his, best effort to be very hawkish. But now that inflation, or at least his preferred measure of inflation, is trending at 3% annualized rates, he probably feels pretty good because we got here without a recession. Now, if he continues to keep rates at about 5%, which I think he will, just to make sure that he doesn't loosen too early, there is a chance that inflation will continue to trend lower. And if there is an accident down the road, maybe somewhere, we don't know exactly where, it might be the real estate sector, it might be banks, it might be something else, you might cause further strain on aggregate demand, maybe through credit contraction. That might lead inflation to be all the way down to 2% or even lower possibly. This is a cycle, a macro cycle in inflation. The disinflationary trend has been pretty strong over the last few quarters. I think it might continue in this cycle. That doesn't mean I expect inflation to stick around 1.5% forever. But if you're positioned for long-term structurally higher inflation, Kevin, you are likely to get washed out. I mean, people who bought the commodity super cycle. It's a typical example. I don't want to point to anybody. I make plenty of wrong trades and mistakes. But that's a great example of cycles against trends. The commodity super cycle. I mean, oil is down 50% or something over the last few quarters. It's very hard to stick to a long-term thesis if you cannot manage the drawdown and be nimble enough to look at the cycle while you still consider the trend.
Well, and I guess this also kind of goes back to your time frame. And some investors are actually long enough that they would have gone into the commodity super cycle and they'll still be there. They'll ride this out. But as you mentioned, in the last 6 months of oil has given up 50% of its gains, and it's definitely painful, which kind of leads me to my next question I have for you is like, how do you go about trading this tactically? Why don't you explain a little bit about your process of how you go about taking these indicators and these insights that you have on the macro basis and turning them into actions and a portfolio?
So look, Kevin, I think to make this simple, there are 3 main components you should try to model when looking at macro investing. One is you should have an idea of where growth is going. And it's the rate of change that matters the most. I mean, this discussion about are we going to have a recession? Are we not going to have one? I think what matters the most is, are we going to grow above trend? Are we going to slow down to below trend? Is the economy going to be more robust than people expect it to be? Those are the real indicators you should try to track, I think, in your macro models. And I have a blend of indicators, let's say, that I try to look at that have some statistical evidence to be able to point in the right direction. So growth is the first thing you should look at, obviously. The second one is how tight is monetary policy, or how loose is monetary policy. And there, I think there are a lot of things to discuss, because even in this case, it's mostly about the rate of change than the absolute level. So we have had some of the most aggressive animal spirits and bubbles when Fed funds were at 5 or 6%, Kevin. And I think people forget that.
Yeah, they do.
The 1999 2000 dot-com happened with Fed funds over 5%. The 2007 housing mania in the US happened with mortgage rates over 7% and with Fed funds over 5%.
I have another one. I always go back to 1987 because I think a lot of people forget this. But 1987, the stock market started, and I think it started at like an 18 PE, which isn't that much different where we started today. And it proceeded to rise 40%, the stock market, in the next 6 to 10 months. During that time, the 10-year went from 7 to 10%.
So, animal spirits are not really only a low interest rate phenomenon. It's about fear of missing out. It's about your neighbor getting richer. You need to catch up. So when I look at monetary policy and I try to model that, it's really, to me, more about the rate of change of credit conditions, real interest rates. It was much harder for asset owners to watch real interest rates move from negative 200 basis points to positive 200 basis points in 2022. That rate of change was too aggressive for asset owners and for valuations. That is much more damaging than persistently high interest rates, especially if the economy isn't folding over yet. So that's the other dimension, basically the rate of change of real interest rates, credit conditions, and so on and so forth. The third dimension is obviously inflation, right? And here we need to look mostly at the inflation cycle if you're trying to be tactical. And if I look at where we stand today on this overall setup, and I'm very tactical and I look at the next month or two, you are looking at growth, which was, all the leading indicators of growth aren't particularly solid, Kevin, but are they pointing to a broad recession? No, not really. You have a very weak manufacturing sector. That's really, really weak wherever you look at. But the services sector is holding on okay. The labor market is slowing down to its trend. It's weak. It's not like a super hot labor market anymore. It's weakening, but it's not recessionary. Most importantly, the expectations were quite recessionary a few months ago, and now they're getting re-rated back to a below trend kind of growth. That's where we are today. If you look at inflation, we just discussed about it. You have, slowing rates of inflation. They're much more consistent with 3%-ish kind of inflation. That's a much better picture than having 6% trending inflation like a few months ago. And then you're looking at monetary policy, which obviously is going to be much less detrimental to asset prices than it was in 2022. So this is not the most bullish setup for stocks in general, but this is also not the most terrible out there. And I think the next 1 to 2 months are rather going to be, the pain trade is not necessarily a break up where you go to 45, 4,600 on the S&P 500. I think what people miss here is the dimension of low volatility. Because I've been in the industry, and when you have low realized vol, Kevin, for long enough, when the S&P realized 30-day vol is at 12% annualized, levels that were basically pre-pandemic levels, when you have that for long enough, risk takers are dragged back in the market.
Well, and it's not just risk takers. It's also even just the vol control funds that
Correct.
increase their exposure. Now, Alf, before we keep going, do you want to go talk to your dogs?
Yeah, I mean, it's not my dogs, unfortunately, Kev, so I would like to shut them up, but I can't.
Okay, no problem. We'll just keep going.
I'm sorry.
No, it's all right. I was just laughing. I was sending Lena notes overhead saying, it's not my dogs this time. It's not my dogs.
Well, unfortunately, I can't do much about it.
Oh, it's all
Try
right.
to focus on my Italian accent. You'll
That's
get
right.
there.
Okay, your
So,
soothing tones and your wonderful accent. Okay, so let's talk a little bit about how your philosophy behind sizing trades. You have, I think you've incorporated a very Jim Leitner checklist before trading. What do those look like?
so Jim is a friend. We talk a lot. We used to talk also when I was at ING. Look, so I think there are a couple of. Let me actually get my checklist. Let me read.
That's good. I love that.
I have it here. Okay. So checklist before a tactical trade. Let me see what I have. There it is. So the first thing that I might want to check here is, and I always ask myself this question, how much consensus is my trade? And sometimes you're going to, answer this question like, whoa, this is really consensus. Like, I'm joining a relatively crowded narrative. That's okay, as long as you're aware of what kind of trade are you putting on. Is it a contrarian trade? Is it a consensus trade? And the way I measure consensus, Kevin, is I have a monitor as well that clients of the Macro Compass get, which is what I call the market narratives monitor. Just build it up. It's very cool. And it takes the most recent narratives and it gives them a percentile based on what sub-indicators of that narrative are actually doing. So it would be like a Chinese reopening, you would track copper, you would track the Chinese renminbi against the basket currency, you would track the Chinese equity market, and you would score them by percentile. So you would get an idea of whether the market is pushing, to the very hot reopening narrative or it's giving up on reopening at all. So I want to have an idea. Is this a consensus trade or not? The second thing on the checklist I have is, am I long carry or am I short carry?
Oh, that's a good one.
And that's quite an important one.
People don't appreciate that one enough.
You want to know if you're in a trade where you're going to get paid to sit in the trade or where you have to pay to sit in the trade. And that's a very different setup because in negative carry trades, you have a time component as well that works against you. It's basically like being long an option at the end of the day. Most short carry trades are insurance trades, right? They make money if something bad happens. And you need to be aware of the time component if you're short carry. The third thing I have is, this should be the first one really. Are you bored or are you trading because there is a setup here with a positive expected value? God, Kevin. I mean, sometimes I'm like, dude, you're trying to look for a trade. There is no trade here. You're bored. Go for a run. Okay. Don't trade.
Oh, that's such good advice. And I wish I took it so often. You're absolutely right, Alf. So many people just trade because they have to. And, Jim, speaking of it, I know this is going to become the Jim Leitner happy hour. And we're just going to talk about Jim. But Jim talks about how he made himself into a small little account that he trades just so he does something. He has a little side account, like a little side hustle where he puts a little money, which he calls it a little money. It's probably the size of my real account. And he just trades it for fun.
Look, it's at the end of the day, it's like being introspective and knowing yourself. If you know you're dragged into trade out of boredom, you'd rather trade them on a small account. So then you're engaged without hitting your P&L. The other one I have is, which is a very important one, is, okay, do you play it linearly or do you use options in this trade? So, a trade is really, there is a macro driver, a macro story behind a macro trade, fair enough, but there are a multitude of ways to play it, right? There is a volatility component you might want to engage with or not. There is a time component. For instance, you want to trade through an option. So I think there are setups where you want to trade linearly and setups where you want to trade through an option. If you have a catalyst, which is upcoming, like you have an upcoming data, many people don't have an edge, me included, in forecasting a single data point, okay? So you have non-farm payrolls coming. You set up a trade which is a dollar-driven trade, a rates-driven trade. I mean, dude, you're basically gambling on the event. I mean, you don't know. Don't make a story that you can predict non-farm payrolls on a monthly basis. You can't.
Right.
So then if you know that the macro data is coming, then maybe it's either smarter to wait. Yeah, you're going to miss the first leg if it goes your way. Okay, fair enough. But at least you don't have the jump risk in front of you. Or otherwise, you can choose to play through options where you know how much you're paying. And even if the jump risk happens, then you can only lose your premium. So that's another question I ask myself. And then I have a few more, but the last one I want to come across with is one of the most important ones. Do you already have this trade on your book?
Oh.
Are you just adding up the very same trade just by calling it with another name?
Yeah.
So one of the ways I blew up at the very beginning of running money in my previous job is, I had 10 trades on the book, and I'm like, oh, look at me. Like, I'm allocating volatility adjusted. I'm sizing it according to a methodology. I'm putting stop losses at the right place, and I'm religious about the risk management. And then all of a sudden, Kevin, 8 trades would blow up in a week.
Yeah, they all go together. I have that too. And you can just tell as well, when you're long, let's just say, well, there's a perfect example. Right now, I think tech and oil are moving almost negatively correlated. So you could say I'm long tech and short tech and long oil against it, thinking that your net exposure in equities is limited. But in reality, you've doubled your risk. You'd be better off just being long tech or just short, or just whatever, just having half the trade on. Yes. Because they're negatively correlated in times of stress.
That's the most overlooked thing. I think people don't look enough at correlations and whether the entire macro book they're running is basically one big trade.
Do you think that there's sorry, I didn't mean to interrupt. Do you think there's edges to watching the correlations and, for signals almost?
Yeah, there is another tool that I have on the website and also for clients. It's called the market anomaly tool. I mean, all it does is it basically screens, a few hundreds macro asset classes, and it looks at rolling returns and the correlations of those over time. And it looks for stuff that is generally very well correlated. I mean, like over 0.6 correlation on a long-term basis. And it scores them, and then it says, oh, look, Alf, that correlation has broken this week. And I found that to be a pretty interesting way of systematizing an analysis of correlations, Kevin, because sometimes you'll find, stuff that is breaking up, and it might give you a signal at the beginning of the year. It was useful on China. So, the Chinese reopening was a very strong narrative, but at the same time, you had base metals, industrial metals. They weren't picking up the signal. I mean, that correlation was breaking. The renminbi was rallying, Chinese equities were rallying, and copper wasn't really reacting according to its long-term correlation. So the tool said, well, if you like narrative and you want to catch a laggard, then you might want to go long copper. And that helped setting up a trade. I think macro, one of the problems with it is there is a lot of information out there. It's just impossible to manage it all and to systematize it and don't get lost in the noise, but have a systematized way to look at this data unless you build some tools that you can use. And that's one of the things I like to do as well for my clients, because it's not always like having an edge on a macro view that makes a difference. It's about having the tools in place to capture some of the signals.
All right, Alf, it's getting later, so we're going to have to cut it off. But before we do that, I wanted to chat about the yield curve. And one of the things that I think is interesting that not enough folks are talking about is the possibility that this time the inversion signal might not work. And I know that's sacrilege, and I can hear already. I was wondering what you thought. Is the yield curve inversion the perfect signal that will always work, or is there a chance this time is different?
Ooh, this time is different.
I know I said it almost to be like...
4 very expensive words in finance. But Kev, we need to entertain the possibility it is. So look, first of all, why would yield curve inversions actually anticipate recessions in the first place? The way I look at it is not that they predict recessions, is that they lead into recessions mechanically. So the way it works is, look, if the bond market is telling you that there is an inverted yield curve out there, the message is the following. Dear central bankers, the short-term interest rate you're forcing through the private sector are too high, So I'm going to discount that you're going to make some damage down the road pretty soon, actually, maybe in a year or two. And therefore, the hit you're going to cause to nominal growth, so through a recession, low real growth, a disinflationary process, in general, you're going to kill the economic growth, basically, and I'm going to reflect that into lower yields at the back end of the curve. Because the front end of the curve is all about monetary policy, and the back end of the curve is instead expectations about real growth, inflation, and term premia over the next decade or so. So if I think you're going to make damage, then I'm going to price it out on the back end of the curve, and the curve is going to result inverted. Now, what happens is that the private sector needs to roll over their debt, their liabilities, their leverage. And as I'm basically having front-end interest rates being higher over time for a prolonged period of time, at some point, I am going to lead into a recession by choking the private sector from cheap credit for a long enough period. So an inverted yield curve is basically, kind of a walk through a recessionary episode. And I think it has a very strong predictive power. I mean, history shows that, Kev. What really people got messed up a bit on here is the time lags.
Right.
Sometimes it took like 18 months for any meaningful curve shape to actually walk us through an actual recession. 18 months, it's quite a long period of time. And I think people underestimated that, especially because the private sector was very smart. And that is maybe what is a bit different this time. In 2021, you could refinance your mortgage at 3% for 30 years fixed in the US. Junk corporates could lock up funding for 10 years at 3 to 4%, extremely low levels. And they did, Kevin, they did.
Right.
They didn't sleep at the wheel. So they locked up long-term funding, which means the famous rollover risk that I'm talking about has been basically non-existent over the last 12 months. So you are not going to be able to cause a recession through expensive credit and choking the private system from cheap credit if the private sector doesn't need the credit in the first place because it has locked up long-term funding. And I think that's been one of the reasons why the yield curve inversion hasn't worked yet. Do I dare to say this time is structurally different? No, I don't think so.
Well, one of the things that folks don't realize is that it's only works in the U.S. There's been lots of examples of European or UK markets where it's inverted and it didn't cause a recession. And I guess you could argue that it's the reserve currency that matters. But one of the things that I'm kind of most interested in, and you mentioned it, you talked about term premium. And I think back to the 80s when Volcker broke the back of inflation. And although we all now know how obvious it was that inflation had been, sent packing and that we were going to have a period, decades of disinflation, it wasn't as obvious back then. And for a long time, the bond market demanded a high real rate. And those real rates stayed high for many years, like 5 to 10 years. And it really wasn't until this last decade that they went so low. And I almost wonder if we're going to have the opposite right now, whereas everyone thinks that we're going back to 2% inflation and that the period from 2010 to 20 is how the world really works. And therefore, they are overextending out the curve because they're, in essence, reducing the term premium because they have the recency bias of the last decade. I'd love to hear your thoughts on that.
It's a great point of view, Kev. And look, let's first define what the heck term premia is. One of the things I hate about finance is that we can all sound smart with this jargon, and in reality, it's all really simple. So term premia is what investors would demand to take duration risk and lock in 30-year interest rates, so buy a 30-year bond, rather than just rolling over a 3-month T-bills every 3 months for the next 30 years. So if you buy a 30-year bond, you're going to have interest rate risk. You're going to expose yourself to quite a lot of interest rate risk. If you roll over 3-month bills, you are not going to do that. So generally speaking, there is positive term premium. So people want to be paid basically to lock in their capital to buy 30-year bonds. And what you're saying is that despite elevated inflation for quite a period of time, despite we have discussed about the risk of inflation being structurally higher than it was in the past decade, term premia are extremely low anyway. So investors are not demanding to be compensated by taking risks and buying 30-year bonds today rather than rolling their T-bills over time. I think it's a very important risk to have on the monitor. I think, coming back to the commodity super cycle, that if you have a view that inflation is going to be structurally higher over the next decade, you have the capital and the ability to withstand drawdowns because the cycle maybe is going to be opposing that long-term structural trend view that you have. There are some magnificent opportunities in macro space where basically long-term higher inflation tail is really not priced. And lower term premium are one way to express that. In commodities, there are other kind of plays. Long-dated volatility is another way because, Kev, let's be honest, if we are getting into a world where inflation is going to be 3.5%-4% on average, then I think a lot of people are going to have to realize their asset allocation is just not equipped at all for that. And this massive flows and shifts in portfolio are going to cause much more structural volatility in markets than what we are used to. I mean, the 60-40 portfolio just doesn't work in that environment. So all of a sudden you'll have people say, ooh, my allocation to commodities is lower. Ooh, I should be allocated to vol actually as an asset class, something that I've been sold. I've sold over time over the last decade because it always worked to sell vol. Now I need to own vol. Yeah. I need to own commodities. Do I have emerging markets? Do I have stuff like Poland, Indonesia? Do I have that stuff in my portfolio? Or do I just have a bunch of Apple and Microsoft in my portfolio? And I think those shifts can be pretty large.
So I'm with you. And when you said magnificent, it was with the beautiful Italian accent. And I thought I'd just end with this little bit here. One of the great, I guess, in most Italians' viewpoints, one of the great tragedies of Canada is that we are home and the originator of pineapple on pizza. And so for those who don't know, Alf and I have gone back and forth many times about this. And what I thought I'd do is I'd actually just finish off here with a clip that I think that you might find interesting. It's a couple, and when I told Lena about it, she's like instantly knew who they were. But I don't know if you've seen this, Alf. But let's just play it, and then I want your reaction.
Carlo, do you think if I ask for pineapple on the pizza that they'd give it to me?
I know, but if you do something so, I can continue to live here. Probably.
Why? It's pineapple. Everyone does it in America.
I know that in America did that, and I try. It's okay. It's good. I can't say that it's not good. But if somebody know that you are my fiance, and here you ask pineapple, I can live here. I can hear everybody stop
so dramatic.
So dramatic. Pineapple in the pizza.
It is a very fair representation, Kevin. I think the guy was very composed, by the way. I would have exploded straight away. So small anecdote just to end the podcast on a very high note. A very close friend of mine is Turkish. So, you're a barbarian Canadian putting pineapple on the pizza. This guy is Turkish, but he doesn't behave any better. We're in Naples. I mean, that's Napoli. That's like the kingdom of pizza. And I sit with him in the most historic street of the city, and I show him the best pizzeria in town. And I'm like, dude, you're going to eat the best pizza ever. And the waiter comes, is like, okay, what do you want? And we all order pizza. And the guy with a straight face goes like, yeah, I'd like to have a margarita pizza with chicken breast.
Is that worse? Is that worse than pineapple?
Look, no, that's probably worse. I mean, I don't know. It's a crime anyway. And the waiter just explodes and says, look, dude, I'm going to serve you a pizza and separately a chicken breast. And if you want to put it on it, then it's up to you to commit this crime. I mean, this is not allowed in Naples. And that was, and he did. I mean, it's incredible.
we have an Italian restaurant here. It's very popular, and it just happens to be down the street. It's called Toroni, and they are notorious for absolutely no substitutions. If you ask for something, they're like, "No, go somewhere else."
Excellent. I like them.
Oh, Alf, this has been a lot of fun. Why don't you tell people about the Macro Compass, where they can find it, how they can follow you, where they can find all this great information?
So if you just Google or type in themacrocompass.com, that's the website of my company. And, what we do again is break down on a weekly basis macro and markets in plain English, trying to connect the dots really about what's happening and making it actionable so that, we have a trade idea, we have a portfolio. You can actually track what we are doing out of our data-driven macro approach and transforming it into something actionable. If you're interested in that kind of thing, then it's on themacrocompass.com. If you're interested in, following me on social as well, the Twitter handle is @Macro Alf. And together with some macro things there, you're going to find some pictures of pizza too, of course. I mean, I'm Italian after all, and it's Twitter. Everybody's so serious on Twitter, Kev. I don't understand why.
I know. They got to just relax. I did something the other day, and I was like, I made a joke about something, and then, I remember, I made a joke about marijuana, and it was like I kind of joked about the forest fires, and I said, all the smoke. I said something about like to the effect of, are we sure that the smoke coming up, down from Canada isn't Todd Harrison and Tony Greer coming up here and discovering our fine Canadian bud? And all of a sudden, every pothead is starting telling me that our pot stinks versus the Americans and they have the best pot. I'm like, dude, I was just trying to make a joke.
Oh God. So don't follow me on Twitter. Just go on the macrocompass.com. But that's better.
Well, thank you so much, Alf. It's been a real pleasure chatting with you, and hopefully we won't wait so long to have you on again.
Oh, thanks, Kev. Always happy to be here.
All right, Patrick, it's time for Talking Charts. What do you have for us this week?
All right, let's quickly review the top 3 things we were watching when we recorded last, and also review what are the top 3 things to watch in the coming weeks. Okay, so let's quickly talk about what we talked about before. Number 1, we were talking about market breadth and the fact that we had that huge spike in breadth. We saw the Russell start to rally. We saw the equal weight S&P start to rally. And we started seeing participation outside of just the FANG stocks. And that really hasn't really stopped. Actually, here, let me just quickly let you comment when I pull up this chart just to show. But when we look here, this is the number of stocks above their 50-day moving averages, and we're about 68% now. And so about 2 out of 3 stocks. We were down around 38% before when we were just recording the show the last time. And so a pretty considerable increase in the breadth of the market, and it stuck. It wasn't just a short-term little thing.
But we are widening out a little. Remember we had this discussion about whether the market could widen out, catch up from the bottom as opposed to go down from the top.
And that was actually an important part of whether or not this market had the gas in the tank to get to 4,400 or higher, because really, in my mind, the FANGs couldn't do it alone. They needed other stocks and indices to help, and a little bit of rebounds in financials and a whole series of other very beaten down sectors really was the additional fuel that the market needed to make this advance. We'll talk about the S&P chart in a moment. The other number 2, we were talking about OPEC as to whether it was going to move the oil markets, and it was a very clear pop and drop.
It was a complete dud.
It was a complete dud. I mean, we got oil here. Let's put up the chart here of oil. We saw oil jump up towards 75 on the July contract and faded. I don't think I want to call it officially a prairie dog, but it did poke above those May 24th highs. And stayed there for like a whole second or two, and then completely it's been selling ever since. We pretty much saw from the peak OPEC news to its bottom about 11% drop, or about $8. So quite the drop off of the highs. We get a little bit of a bounce here, but this is still a very distinctly bearish downtrend. Failed rallies, holding down along the lows. I know that one smart guy that says there's no such thing as a triple bottom, and so this is not looking good, is it, Kev?
No, yes, you're right. I can't cherry pick the rules, right? Like that's even a quadruple bottom.
Yeah.
One of the things I will kind of mention, though, Patrick, is that the sentiment is getting so washed out. We have a situation where Goldman Sachs finally capitulated. That was Jeff Curry, one of the big bulls. He changed and finally kind of brought down his target prices. I saw in the FT, the Citibank analyst that had been bearish, kind of almost doing a victory lap.
Yeah,
I almost think that if we got to a break below that quadruple bottom.
Wait, do you know what that's called? Can you say it?
Quadruple?
No, it's a turtle head formation.
Oh.
It's you have to call it by its name. Absolutely, a quick drop below all these previous lows, maybe down even as low as $60. But I would be incredibly temporary. It would be just simply short-term liquidity-driven drop. But a quick washout down there would just kind of capitulate, knock out all the stop losses, capitulate all the traders, and then allow there to potentially be a bottom formed. But there's nothing to say bullish here. This maybe that's a sign. Maybe that's the sign that it's about to be bullish because it's so bearish. But at least technically there isn't a reversal that we can, start talking about. The path of least resistance is down and the bears are in control. Until we see this trend shift, you have to be on alert that there still might be a little bit of a washout at the end here.
I really cling to that belief that there's no such thing as a quadruple bottom. But if I'm going to be proven wrong, this is where I'd like to prove wrong.
There you go. Number one, the FOMC. Now, we didn't know we were recording a little bit early, so we're recording right before the FOMC meeting. We don't actually know what the results were. Any insights into what you think?
I would say that going into this inflation number that we had today, the markets had priced in around a 20% chance of the Fed raising rates. And that's, the more likely than not, they're going to be on pause, but there was still that 20%. After today's inflation number, they took that right out. It's back down to 2 or 3%. So the market is spoken. The Fed's going to pause this meeting. And the real question is what happens next time, and how does how does Powell position himself in terms of the conference or the Q&A afterwards?
Yeah, well, we will get to see that, but we can also talk about probabilities on the CME futures in just a second. So let's talk about the top 3 things to watch over the next couple of weeks. So the first thing that I want to talk about is this the peak pain trade capitulation?
PPTC.
Yeah, the one of the things that to give you credit, I mean, you were very clear about it for months, which is that it's just too consensus to be bearish, and there was plenty of pent up energy for the markets to rise, and generally the trend has been very distinctly showing the bull characteristics of higher highs, higher lows, all dips being bought, above all moving averages, above all trend lines. There's been nothing bearish other than sentiment. And really this rip in the markets here has kind of driven people to go and chase, right? And there was a headline from Goldman saying that this rally people don't believe in, but they have finally given up fighting against it. The question here, are we, maybe not necessarily today, but are we seeing finally the capitulation, and are we going to see everyone being forced to simply go bullish, even if they don't like it?
I think we have.
Yeah,
that's what we're experiencing. You're right, Patrick.
So is that the peak, though, from that perspective, right? I mean, it doesn't mean that the market can't go a little bit higher. It's not peak as in peak of the stock market high, but is it peak from that emotional breaking point that is really everyone that's been bearish just has to say, like, this hurts too much, I have to get in?
So one of the things that I would consider in terms of the peak is it peak relative bullishness of that kind of FANG/tech/AI versus the rest of the market. And I'm willing to go out on a limb and say that there's a good chance that we're experiencing that right now as we speak. I was pulling up the FANG chart, which I didn't realize is just a great index with great futures in it. Like, have you gone and looked at what's in this thing? And it's equal weight. I see. In my day,
is it this one right here, the Micro NYSE FANG Plus?
Yeah, And I remember there being Chinese tech stocks in there, and I used to not play it because it was filled with Alibaba and stuff. And I guess they got rid of that, and it's also equal weight by the looks of things because they're all around 10%, give or take, the moves that have occurred since the last rebalance. But listen to this list, Patrick. It's NVIDIA, Netflix, Tesla, AMD, Meta, Amazon, Google, Microsoft, Snow, and Apple. It's awesome. It's got the big seven, and it's
don't say it's awesome as in that it's something you're encouraging members to buy because
I'm not saying
it's awesome
that at all. I'm
for
saying
anyone
it's
who's
awesome.
owned it over the last.
No, I'm saying
half
it's
a year.
awesome as it actually completely the opposite. I'm fading this because I think on a relative basis this is extremely extended. We're up 80% from the December or the January low.
Oh yeah. This FANG index, it's 86% off of the lows in 200 days. But the key here, though, is we're approaching those 2021 highs, which are virtually just 300-400 points higher from here. And
the other thing is, the one thing you've taught me, Patrick, is you've showed me how the slope of the increase is getting steeper and steeper.
Oh, absolutely.
Do some of your technical magic there and put your lines on
you
there.
You could just simply observe that the technical slope of the rise accelerates, and that is usually showing something that is not sustainable, and that it often will increase the chance that there's going to be some mean reverting move at some point. And so as we approach these previous highs on this FANG index, that's going to be a real tell as to whether or not that becomes a resistance level for this on the upside. But nonetheless, that's my number 3 thing to watch. So number 2 is we want to watch those global PMIs coming out next week. Obviously, everyone seems to all of a sudden have forgotten about the potential of an economic slowdown, or at least they can no longer be leaning into it since they're being forced to buy. But it'll be interesting to see whether these PMIs in any way, are continue to weaken, or whether we see a rebound in the numbers. Anything that you're looking at?
Well, gun to my head, I actually do think the economies are slowing and that we are going to get increased kind of the at the margin things are slower, and I'll buy that. The question is, what happens as the economy slows? If we get a situation where the economy slows, but it doesn't slow enough to put us into a recession, and that kind of fabled, soft landing becomes more and more probable, or increased in probability at least.
I just vomited a little bit in my mouth. Okay, go on.
It's because you had 7 beers before the show. No, but if we do get that and it ends up being that it doesn't end up being a hard landing, I think you could get a situation where stocks rally, curves steepen, and it actually ends up being risk on as the economy slows. I'm not sure that slowing economy, I'm not sure that means risk assets go down.
Okay, no, I'll agree with that. I think that the PMIs are not going to be the catalyst. I feel that there's much greater chance that whether it's the July or August jobs numbers, or it could be the July earnings cycle, where suddenly a downwards revisions of corporate earnings could do it, or it could be delayed all the way until some sort of like Jackson Hole event or something at the end of the summer. I doubt it's PMIs that are going to be the equity mover. I actually think number 1 on the list, which is the post-FOMC market volatility, would probably be even more important than the PMIs in terms of what happens here. Let's the way I look at it, Kev, everybody has been waiting for the supposed pivot. But the problem is pivot is not an easing cycle. The pivot is really them stopping their rate hike cycle. And the thing is that the market is almost euphorically rising here. So I love just looking at this. I don't know whether you drink the Kool-Aid that the CNN Fear Greed Index is a great gauge, but you can see here that it's at its extreme greed reading, and we're doing that going into a Fed that is literally pausing something that people have been waiting for a half a year to finally happen. And
Are
so
you
the
sure
question,
that's not the extreme greed of the CNN execs?
probably is.
They're just putting what they feel. I feel extremely greedy. Let's go for a contract renegotiation. No, Patrick, I'm with you.
But just make my point. I want you to make your point, but I want to just say it would be really interesting to see if this is the buy on the rumor and then sell on the news event going into the FOMC. Now, I don't actually think the bear decline is coming right from the peak here, but will we at least see a short-term swing high in the markets? Like if I quickly put up this chart and then you can kind of give your feedback. But we now have had this little rip on the upside, which has been a month and a half or so of price action. But every 2-3 months, there is one of these 200-300 S&P point style corrections from the highs, right? And these things happen all the time. And the thing is that now that this market has made this kind of an advance, will this open the window to potentially a quick drop lower? And then, you have things like, for instance, that JP Morgan whale. Will we see there being gamma pins that start, pinning the market into the rest of the month in that 42 to 4,300 pocket? There's a lot of really big questions. So now, what's your take on that?
Am I allowed to talk about the whale? Is this the point where
why don't you start off by making the point just on the FOMC fade, and then we could talk about the whale.
I think that you're early on the FOMC fade. I don't think markets turn on FOMC like that as much, and I especially don't know if it'll be on this situation because it's most likely going to be fairly boring. Although I'm with you that the market's overextended and due for a pullback, and actually, if I had to choose up or down, I'd probably choose down from here for if I was just trading it for a week. I think that more likely is that JP Morgan whale, when that option expires, if you were looking for a change in trend, that would be the likely time that it occurs.
Yeah.
Like if you were looking for a point where there would be renewed selling, I would say the flipping of the calendar into July is more likely to be the timetable than the FOMC or even this OPEX.
I am highly suspect of what happened on OPEC news on oil. Something like this can happen here in the coming week, where maybe the market even gaps higher, maybe even blows through 44.50 on the upside on the futures, and then some sort of just a reversion. Again, I don't want to call that the next bear market leg where we're going 500 S&P points lower, but every rally is checked, and every advance has sort of a pullback.
You're looking for a check. What do you consider a check? How many S&P points?
200 S&P points.
Okay, I'll take the other side of that. I say it gets boring, and actually volatility surprises us with little happening over the next 2 weeks until June 30th.
Okay. Well, maybe there's some bet coming up here in this little window. We'll talk about that after. Anyway, so those are the top three things to watch there. So Kev, let's actually talk about the options activity. Obviously, we have option expiration coming up this Friday. Maybe that could have easily been in the top three things to watch. And obviously, there's a lot of gamma jammed up, and there's this, the question here is, are we going to see actually dealers forced to actually buy upside if this market accelerates on the news? There was some sort of, I don't know if you can collaborate, but I've heard that there was a gamma flip potentially at risk of where dealers will be forced to buy into the strength on the upside. Do you know whether that's still the market condition?
I didn't see that. I don't know that. On the whole, generally,
that's not the case.
Yeah, that's not the way it's
No,
set up.
this is
Maybe I'm
what
wrong.
makes
Maybe
it
I
a
don't
really
know the nuance of this. I'm kind of suspect of some of these things because I saw all these guys. I can't remember if it was this expiry, like this quarterly expiry, or the previous one. But everyone was talking about the monster exposure at the 4,000 level, and I was looking at it and I was like, "That's a big, huge box trade between 4,000 and 5,000," and there was absolutely no actual gamma exposure from that trade.
Yeah.
So you need to be very careful and suspect. But the one trade that we do know how everyone's set up is that JP Morgan whale. And so you have to kind of assume that they're not the only ones doing it. So on the whole, that's how clients are set up, that they've sold calls up here.
And it's at this 43.20 level. Is that the correct?
That's correct.
level?
Is that it's 43.20 on cash, but you're looking at SEP futures,
Yeah,
right?
so, okay,
SEP
let me-
futures have a fair value of around $40, $41.
Yeah.
So really, it's like 43.60 on SEP futures.
Okay.
So that's where it is. But
There you go.
that was the tractor beam pulling it up, and now kind of on the other side of the strike, we're going to get a little bit of. It's not as big. There's more tractor beam action on the pulling it up as it to pushing it down, but I think we're going to get that. I think that I've been saying don't get too bearish.
You think that we're going to have it pinned into the June 30th at that level?
Yeah, I think that all else being equal, in the absence of anything else, that's going to the market, the dealer's market position is going to increasingly favor that's where we are at the end of June 30th.
Okay, so if you were for the next 2 weeks going into the end of the month, what would you say the 2-week high-low range is going to be contained to in terms of points? You clearly don't think that there's going to be a 200-point drop. So
so there's going to be no 200-point drop. I don't think there's going to be a 200-point rally. So I don't know. I'd have to go look at the numbers, what we should expect.
I want you to make up a number that kind of puts a number to your conviction here.
You're putting me on the spot.
All right.
Well, let's just do this. 1 second. Let's just do this. Let's go look at what the S&P is pricing for the 43.20 straddle.
All right.
Can you do that, or do you want me to pull it up?
I actually don't have my options thing up.
Okay, let me just. It's not like you do that for a living or anything.
No, but I just don't have it loaded, buddy.
I'm just
markets are
kidding you.
closed.
Come on. Yeah, 43.20 is $82 on the call, and on the put it's $23. So what did I say? So 585, 105. So that's 105. Yeah, I think that's probably fair.
105. Okay. All right. So let's keep.
One thing I want to be clear though. I actually believe that the last day, the June 30th, doesn't count because they unwind it, and so so I think this is important that you should be gone by June 29th, the night of the 29th. They pin it the night of the 29th. They don't pin it on the 30th because by the 30th they've already rolled it.
Okay. All right. Okay, so let's talk the rest of the markets here, bud. Dollar index.
I'm so proud of you, by the way.
Why? I didn't put the dollar in there?
Yeah, you didn't put it in the top three.
I'll put it in the top three when I think the dollar's ready to go. Right now, my call has been for months that we were going to stay pinned in a sideways trade range until some sort of true economic slowdown risk-off cycle begins, and I don't think we're necessarily close to that. And so we could easily work our way back down to, let's say, 102, and then rally back to 105, and just chop around in this for months until something ultimately breaks. But if I was going to be put a gun to my head as to which direction the trade range breaks, I think the dollar goes higher.
Of course you do.
But
tonight at 11.
Doom! What was so doom about the dollar rallying? You had to
the
just
way
do that.
You're like, of course it's gonna rally. It's gonna be doom. You talked about some risk off event that was gonna cause it to rally.
All right. So there we go. I mean, I wish I could make a longer term bet on this. You could price an option for me on this. Okay. Anyway, so right now though the trade range continues to prevail, and we'll just leave it at that.
Good for you, because I know you have a tendency to want to buy it, and you've correctly just said there's nothing happening. Don't get excited about it.
Yeah, this is not the right time to pay attention. I think generally being underweight currency positioning here, other than maybe some of the yen, US dollar yen type of thing and other plays that have been working, but mostly it's better to be completely underweight currency trend moves and wait until the market sets up for something that could be a big move. And I just don't think that's right away.
Here's a question I have for you.
Okay.
What do you think? So we saw everyone used to trade stock market vol. And then this cycle, everyone started trading fixed income vol because that's where all the action was. The one that hasn't kind of gotten the attention of the traders yet is the FX vol. Do you think it occurs? Do you think we get a move like we did on the move, like the bond vol in FX?
I don't think so. Not this year. Not this year.
Oh, okay.
I look, inevitably when global geopolitics changes landscapes in many years to come, there will be some huge currency volatility. But I don't believe, even if we had like a recession and other things, and let's say there was money flow going into the dollar during a risk-off cycle, I don't think this is going to be a monstrous repricing of the dollar and some new epic bull market in the dollar. I think it would just be a purely, a cyclical trend move, that it would be a intermarket move based upon flows. I wouldn't make a bigger deal than that on it.
The one thing I would say is that once the thing starts to heat up, sorry.
Yeah.
Sounds better when I say hot up.
Yeah.
It's tough to buy as the vol's exploding. And one of the things is I kick myself because I said it time and time again. I said, bond vol is what you want to own over stock vol. And then I didn't do it. And it was like one of the greatest trades, and I don't deserve any credit because I didn't do it. But it was probably the greatest trade of 2022, 23, right? Like, is to buy bond vol, 21, and sell stock vol.
Yeah.
And I think we're going to get a situation where as economies differ, like I think with our economies, we're roughly all on the kind of synchronized, as the stress between the difference in the policies increases, we're going to get more pressure on currencies. And I'm not sure as you are that it's going to be something that you don't want to have a look at owning, because I think timing is going to be difficult, and I'm not as sure as you are that it's not going to be this year.
Well, I'll tell you what, at minimum, I feel that there's a very reasonable chance that the rest of the summer going into Jackson Hole, that the currencies are not going to have made big moves. So, as we get into the fourth quarter of the year, if conditions are there, of course, the unfolding reality of the markets may make that a smart trade. I just don't think that you need to be rushed to put it on. You can still size this market up over the many weeks or months moving forward. I don't think you have to feel an urgency to get in now because you're going to miss the boat, right?
Okay, fair enough.
So we talked about crude oil. I won't talk about it because we already mentioned it, but I wanted to just talk about the very disappointing follow-through rally in gold. So when this first drop in gold happened, I'm always interested in buying dips. That's just my mentality. I don't buy rips, I buy dips. And this type of a pullback in gold was the type of pullback that gains my interest. But what I always do is when I'm getting into a new trade, I always want to see follow through, something that's proving that you're on the right side of the trade. And really, the gold bulls just simply have not shown up in the last week or week and a half. And the fact that we can't clear 2,000 on the upside, it's not a vote of confidence for gold bulls on the short term.
And Patrick, I got to give you credit here because we started joking about the no such thing as a triple top, and we agreed that there is no such thing as a triple top. But you said in the meantime, you could have months where it goes down and then goes back up to test it. And you were right. You have been preaching, take your time on gold. You said it was going to dip. It's basically following what you said.
Yeah. Well, thanks for the shout out, but overall, this price action still leaves the window open for a dip under 1900. And that doesn't make it a bearish trade. I mean, unless you're a swing trader and you're throwing down hourly charts and you want to clip yourself a quick trend move if it breaks. But generally, I don't see any reason not to stay long gold. But, you know, when you have gold offering an option skew that's a clean smile, and you're able to pretty much be able to do very clean zero-cost collars on gold, I just think carrying a hedge during this window makes a little bit of sense. And just waiting for the bigger setup. I think there will be a big gold bull market, especially when the Fed is in some sort of a future easing cycle. But that's not anything imminent, and I think could be a lot of short-term chop in gold.
Okay, what else you got?
I don't even want to talk about the VIX, so that we get into this whole thing of you saying this that. Okay, I'm not going to say anything.
Go ahead and talk about the VIX and how you think it's too low and how. It's got to
be then I'll bring up the VIX so you can tell us that it's not low enough and that it could easily go down to 12. Are you done? Can we move on?
Okay.
All right.
Oh, I had the greatest tweet that I included in my I do a roundup, and it was something about. Let me see if I can find this here. Guess what the original price, the non-split price of UVXY would be if you had kind of held it. Oh, here it is. Russell Rhodes. So he says the upcoming UVXY reverse split is the 11th since it was launched in 2011. Fun fact, split adjusted first day closing price so what is UVX right now? Let's tell you.
It's right now at $2.26.
Okay, so how much was it 11 years ago on a split adjusted basis?
What is that, in the billions?
No, it's not in the billions, but it is 2,058,000. No, wait. Sorry. I think it is in the billions. I missed so many zeros. Holy shit. Yeah, it's 2 billion.
Yeah, that's been a very successful carry. Anyone that has stayed long this
stayed long. You mean stayed short?
Staying short would have made you a stupid amount of money. Absolutely.
Yeah, and you just with just moments of sheer terror.
Unbelievable.
I thought that was a great stat.
Yeah,
it's
you know what I mean.
The wealth
generally,
destruction in this thing of people buying VIX throughout the years is monstrous. I'd love to figure out how much dollars has been spent doing that.
How many people have you been using the VIX to hedge and just burning money?
Yeah,
that's a good question.
Now tell us why it has to go up, Patrick.
Well, I am not encouraging people to go long volatility through this. But I'll tell you right now, with the VIX level where it is, it's never been cheaper to hedge this market. Not for a while, anyway. It's been years since you could put on, especially with higher interest rates, making generally puts more reasonably priced. You now it's not that expensive to protect the downside risk on the markets, bud.
Well, that's fair enough.
Okay, so I want to talk nat gas. And one of the calls that I made after a failed rally in March, that was a pathetic bounce, it could have been so much more, was that this was going to stay dead for into the summer. And it's that trade range has now prevailed. The bigger question now is there going to be a potential move beyond just it rolling up the term structure? Because obviously out to like December, what is it? Like, I think out to December, it's near $4 on the December-January contract. So, I mean, inevitably, if we wait long enough, we're going to see this continuous chart just roll up the term structure. But do you think that there's room for nat gas to actually make a move beyond that?
Yes.
You do, eh?
Yeah.
So are you back to buying the strip by any chance?
I don't know. Let's not goocher it.
Okay, I'm gonna say we're not gonna say anything. Copper has been bouncing, and this has been a retracement. I've been talking about it. You can even make it to 390 on the upside, but I just am very reluctant to get too excited about this very oversold bounce just yet. I mean, if it came back, established a basing formation, retested lows, and we're on the and we're in the midst of already some economic slowdown that there's a potential green shoots on the other side, then maybe I'll be looking for copper to start its next kind of bull phase. But I don't trust this rally.
Okay.
Do you send another Gucci? I'm not going to. We're just moving on.
I know. I have a little bit of copper. I'm not I'm not pulled up on it or anything. I just longer term. I think you got to own it. And so the question
longer
is,
term.
what do you hold in the meantime? Oh, the old uranium.
Yeah, this is the U308. But what's interesting
for all the uranium bulls that are just like going, oh my God, he's going to Gucci. He's going to Gucci.
No. You're welcome, Kev, because you said we're not going to talk about it 2 weeks ago, and
it kept rallying, but now we're talking about it.
No, all I just wanted to highlight was that U308 has distinctly broken out and has continued to rise. And it will be really interesting to see whether it can make it back to those 2022 highs up around 62, and whether or not the bulls can generally keep this price action on this bull side. It's they've done a pretty good job so far. It'll be I'm not going to say anything else, and I won't other than that it's been pretty bullish.
Okay.
Just touching Treasury bonds continue to be stuck in the mud. What's your thinking here? But I mean, I am standing by my view that I still think that the low of the year low is already in. I don't think we're going to go much lower than 110, even if it gets down there on the short term. I think that the kind of bigger move in Treasury bonds, even if you're right about a bearish move and higher interest rates, I think that that's in the years to come and not in this calendar year. Do you still stand by a very bearish view here?
So for a little while, I was becoming less bearish as I wondered if we were going to get a pause in the economy or a slowdown in the economy. I listened to Dalio the other day, and I was like, "Oh, geez, you know what? He's got me rethinking even trying to ever gingerly play bonds from the long side." I think that there's, I know, like you know what? Dalio is kind of like my what's your guy that you have up on your posters on your bed? Gary Schilling. Or the other guy?
No, Lacey Hunt.
Lacey Hunt. They're both big deflationists, so it doesn't matter. You have them both. It's kind of like Farrah Fawcett and Cheryl Ladd. Only the Gen X and some of the boomers will get that joke. Okay. So, Patrick, I've been really thinking about this, and I think the curve steepens. I know that's what I always think, and I'm always wrong.
Bull steeping or bear steepening? Because I mean, steepener is a no-brainer. The question is, how is the curve going to steepen?
I think that the front end doesn't move. It depends on where you are on the front end, but I think the Fed goes on pause. It actually causes a risk on move, and while that's happening, you get bonds that are declining. And I talk about this all the time, but everyone they always forget 1987 when everyone loves to talk about all these different years, and they forget 1987. 1987, bonds started at 7%, went up to 10. Stock started at 22 or 18 PE, went up to 22. They rose 40%. So we had stocks screaming higher all year up until October, and you had bonds just shitting the bed, like 7% to 10. Meanwhile, stocks just kept ripping, and I know that's a low probability event, but I think that people should keep that in mind. And interestingly enough, Patrick, did you look
what was the monetary cycle that was happening at the time? What was the Fed's position back in that window? Do you remember?
So I should go
because
better.
I think that you making that comparison without. Well,
there's always going to be something different. So it's always
going to be different, but
it's the point is everyone says, "Oh, bonds went down, so therefore stocks can't go up," and I'm always like, "No, that doesn't work. they can go completely opposite, right? And that's what I'm saying. And I think 85. Let me just look here. So the Fed had loosened, and in 86, and then was on a tightening cycle. And so the Fed tightened in September of 87. They took rates from 6 to 7.25. And the long end was saying that you're not tightening quickly enough. And anyways, I'm really hesitant to get on the kind of bond bull wagon. And I get it. I understand all the reasons why they think. Ultimately, it comes down to this, Patrick. Do you believe we are returning to a 2010 to 2020 environment? Like, do you think there's going to be some sort of dramatic risk off?
No. I think risk parity is done in all the 60-40 portfolios. But
if you think we're going back to 2010 to 2020, then I understand why you own the 10 years at 3.5 or whatever it is. Like, it makes sense. If we're going back there, that makes sense. You should lock in.
But I'm not. Listen, I'm not going into a bond bull camp. Okay, I'm not actually uber bullish, but I do believe that if we saw that, I still believe that we would have a very natural intermarket relationship. That if for whatever reason, I know that you are already implying that we'll have there could be a soft landing and the markets just not give a shit. But I honestly think that there will be a point where there's going to be a risk-off event. And it may not happen immediately, and I'm not immediately already calling for it. But when we do, I think the natural intermarket relationships of yields down and U.S. dollar rising in a period where risk assets are being liquidated is still got a very reasonable chance of happening.
Oh, I'm not disagreeing with you that we'll have periods like that. My question is, when you're looking a year later,
I'm not making a year later call. I'm talking about the fact that I think that we're clearly going into a period of some sort of an economic slowdown. We don't have to use the R word, but I just don't see that as a scenario where bonds break to lower lows.
Okay, at least you're saying that. But a lot of what I can see happening is we could get a situation. I really think that the next crisis is going to occur from the bond market, not from the stock market. And I've said that forever. And I still hold by it. And so what we're going to see is, what if we had a situation where bonds went down, and next thing we knew, the 10-year was 5%. The curve just went flat. And then the stock market finally said, "Oh, that's too much," blah blah blah, and they sold off. And then all the guys would say, "Look, you know what?" The bond bulls would say, "Look, you know what? It's that relationship still exists." And I'm like, no, bonds were the ones that sent the stocks down because they went down for whatever before. That's why I bring back 87, because 87 ultimately the rising yields, the puking bond market was one of the catalysts that caused the stock market to eventually, have its crash.
Yeah.
And so I think that if you're right and bonds don't go anywhere, and we just end up staying here at 3.5, that you won't be right about the stocks will go down, and therefore bonds will rally from there. So what bonds are going to go? So they're 380. I should stop saying 3.5. There's 380 on the 10-year. And so let's say stocks go, and let's just say they stay flat here for the next 6 months, and then stocks go to 5,000, and then they collapse back down to 4,200. And then are you saying that at that point bonds go to 2?
On a yield, I think no, 2.25, because I think the 120 level is possible. Like, I think if you look at this chart on the 10-year, I think we can have a rally that gets this thing back up to 120 on the 10-year note futures. And then in 2024-25, I could see a scenario where you end up having still a breakdown in this when the conditions are there. I just think the lows are in for the year, and I think there's room for this thing to have a pop into a slowdown of some sort.
Okay, listen, if you're trading the squiggles like that, I agree. I just think that the surprises are going to be the other way.
Yeah.
Like that's my main worry, is that you're sitting around and we're using old kind of playbooks, like playbooks that worked in 2010 and in 2000.
There's no doubt. I think that the intermarket relationships are inevitably going to start to evolve, but I just don't think they just change like this in overnight.
Okay.
You know, but you're right. I'll agree with you. We're not going back to 2010, 2020 window of intermarkets. That's not happening that way. All right. Last thing I want to just touch on before we move on is this rip in the Nikkei. It's interesting because obviously a very bullish trade. I know you've been on the right side of this trade for a while, and therefore you're not going to say too much. But what do you what do you think of I've heard a couple of strategists come out there with the long Japan, short Europe pair trade. Are you pairing it, or are you just going pure long?
No, I try not to think about it. This one I just buy it and put it away. Like I love the banks. I love everything about Japan. I love Japan.
You should go and scout it out one time.
Yeah. I should.
Anyway.
Listen. The trouble about the long Japan, short Europe trade is that it's already moved a long way.
Yeah,
and
that's a late in the game. Like, where I believe though the trade could work is actually the fact that Europe is so heavy, and so if there's a correction, I would argue that Europe might have more downside than Japan. And so it's one of those things that could work in the favor. If a risk-off impulse, it'll still be a winning trade.
I'm not going to fight you there. And one of the things that worries me is this LTRO or whatever, TLTRO, whatever, when they're having to pay back and their ECB is tight. They're reducing their balance sheet. There's a lot of worries out there. And the other thing about the Europe is that it's kind of heavy with weird like luxury stuff. Right? Like I don't know if I want to own LVMH or whatever it is and all these fashion companies. Like that's not really what I want to own, like a real I want your real economy to be going instead of selling, Ferraris to Chinese guys. Like
All right.
I feel better. No, I feel better
last
if it was
thing,
like more broad, I guess.
Yeah. So last one I want to just touch on. This is a weekly chart of Brazil. The Ibovista. And did I pronounce that right? Ibovista?
I have no idea.
I think it is.
You know what? They're such nice people, they won't care. They'll just be like, they're just so kind and nice, they don't care.
Yeah.
They're not going to get offended.
This rally, the bigger question, after this thing spending better part of 2 years consolidating that really big rip it had in the post-COVID period, are we seeing the beginning of a new advance? It's interesting because there's a whole array of these emerging markets that are starting to get interesting, and Brazil is certainly one of them. Are we going to finally see these some of these emerging markets getting more and more attention? I know you're a big fan of Mexico.
Yeah, I love Mexico. I love Brazil. Think about let's go back to Brazil, though, just briefly.
Yeah.
This is occurring with commodities just kind of sucking wind, right?
But did you see Petrobras?
No, I haven't paid attention.
But look at the rip in their Petrobras.
Oh, that's interesting.
Right?
What's happening there?
I'm not totally sure of what caused this rip, but it's certainly diverging from many global energy plays. Right, most energy is stuck in the mud. And these types of plays have really come back to life. And so some of these Brazilian plays are getting attention.
I just love it. I think you got to look at. I think one of the big mistakes a lot of people will be making over the next couple of years is to be too overweight the U.S. Everyone loves talking about the U.S. We spend all our time arguing about where the S&P is going to go or the Qs are going to go. Meanwhile, there's bull markets happening everywhere. There's cheap stocks that are finally behaving well. Go buy those instead of buying NVIDIA at 35 times sales.
Right. Okay. That's all I got, Kev. Anything you wanted to last chart you wanted to look at? Or
we're not going to talk about SOFR?
We can. Okay. So we were running out of time, but all right. Let's do it.
How about we save it? Do you want to save it?
No. Let's quickly just
Okay.
the point. The point is obviously looking at the interest rate path. We continue to see. Obviously, we have interest rates over 5% on the September contract up here, and the interesting thing is that we're seeing obviously rate cuts being priced into 2024. But you were observing an interesting kink in the curve, right? So why don't you kind of
Well, if
explain
you
what
pull
you're
up
seeing?
the curve, you'll see that they have one more hike priced in essence, and then they'll have sometime in the fall. I guess it's whenever they got it coming out, and then we have a severe kind of Fed cutting cycle, and they got SOFR going from 5.25 down to 3.25, 200 basis points coming out in the next kind of 2 years.
I wouldn't call that severe. I don't think severe is them going back to like 1%.
You're probably
Like,
right.
This is
okay. So fair enough. Fair enough.
But this is certainly.
I misspoke. You're right. You're right that isn't severe, and ultimately, I think that's why it's priced like that, because there's in everyone's back of their mind, there's that little nagging feeling. They're saying like, we could be back at 1%. We've done this before. And one of the things that I am kind of understand people's kind of concern is that when you're looking at this curve, you're looking at what the market is priced in, but we're not looking at the distribution of those returns. So it could be that actually one set of path is like the Fed goes to 5 and just kind of stays there. And it's almost like if they're going to cut 50, they're probably going to cut 250. You see what I'm saying? Like,
Yeah.
it's not it's not going to be a nice easy path. If we go down to 3.25, it probably won't be in a nice gentle way. It'll probably be it's either going to be more like the Fed sticks here and maybe cuts once or twice and looks at it and then cuts 200 in a really short period of time, or it's going to be a situation where the economy ends up being stronger and maybe they leave it here. Maybe we even end up higher.
Well, of course, the curve is always reshaping based upon known information. So, I mean, that's what SOFR traders do for a living, right?
But I'm just saying that the distribution of returns on the path cutting is something you should need to think about when you're looking at this curve, and it's not truly reflected in there because it's reflected in the options.
Well, I think also it just demonstrates naturally how we're going to have the negative yield curves once again turn positive. Then that would be a bull steepening, because if this was happening, you're obviously thinking it would be a bear steepening.
Yeah, I don't think
based
that's
on-
going to. Absent your doom at 11, that's not happening.
Okay, well, let's.
One last question. One last
yeah.
comment while we're talking about SOFR, though. For those who don't know, the euro dollar used to be like the 3-month LIBOR, and those no longer trade. I think there's one last contract. They've all, kind of migrated into the SOFR, and so that's what you should be looking at instead of ED. You should be looking at SFR.
Right. And on Trading View, I think it's SRs, right? Hold on a second. Yeah, you to SR3 is on Trading View, but on Bloomberg it's SFR, right?
Yeah.
All right. So Kev, I think that's enough for talking charts. So let's do skin in the game.
All right. So we're taping this on Tuesday, and we had made a bet that was actually expiring on Friday. And the bet was USGPY at what was their level?
139.91. And so as we speak, I've got a slight edge, but it's pretty much
it's right there.
Flat. Like
So what we're going to do...
We're at 140.19.
Okay, so what we're going to do is we're going to still settle it up based upon Friday, but we need to decide who's going to make the bet for this week. And since Patrick's winning right now, he is going to make the bet. And I have a feeling he's going to use my stupid shooting my mouth off about the the amount that the S&P is going to move. But let me tell people about Skin in the Game before we do that. Skin in the Game is our weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, every second week. And the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode. And whoever gets to 50 first takes out 3, or, depending on how you look at it, unlucky Market Huddle listeners for dinner. All right. Patrick, what do you got for me?
One touch, 42.50.
42.50 on what?
S&P, the SPOOs, the SPOOs.
4250. One touch.
Obviously for the June 30th close.
So first of all, if we're going to do this, you obviously want me to not take that. If we're going to do this, I need a little bit of a change here because I very strongly feel one way that I don't want June 30th. I'll do June 29th. So that's the first thing we need to do. So tell me, are you willing to entertain that?
Well, if we do the 29th, we have to bump the number.
Okay. I'll give you 3 points or whatever it is that you
3
wanted.
points?
Well, one day. Let me just see. Okay, 1 second. I got to make sure you're not ripping me off here on the...
Oh, my God. You're pricing it on the Bloomberg, you piece of shit.
No.
Here I'm off the cuff, making a bet. You're like going...
Would I do that? That sounds really...
You're literally doing it right now. You're delaying while you're typing. I can hear you.
That sounds really scummy. It doesn't sound like something I would... Okay, I'm not going to do it. So what level do you want then for the extra day? No, screw it. 4250. I want
30 close.
I want the 29th.
Oh. Okay, fine.
Okay.
You can have it for the close of the 29th.
Okay.
Before you guys put a wager on, I need to read you guys something from a listener. This email was titled, Lena, raise the blinds. We agree this skin in the game tourney will go on forever if Kevin and Patrick keep betting 1 point, right? It's time to bring in Pit Boss Lena to raise the blinds. 3 point minimum bets in June, 4 point minimum bets in July, and so on. Let's turn up the heat.
I'm for it. I like this guy's style. So I guess it's 3 points, Patrick.
All right, I'll take it for 3.
Yeah, you probably wanted 3 points. Okay, 4250, one touch on cash, June 29th.
No. SEP contract. Not cash.
Oh, okay.
This is the September future.
Oh, okay. Yeah. I'll take that.
Okay.
42. What did you say again? Repeat it again.
4,250. One touch on the September SPOOs.
Okay. That's fair enough. Okay.
All right. Done.
And it's going to be the 4:15 close on the 29th.
Right.
Or
whatever the candle prints on that day.
Yeah, like that day's close, like the 29th, the day before.
Yeah.
Okay, 3 points. That's our new minimum. Okay, I respect that. We're going to do 3 points a round. So what's the score right now? Like we won't even make it through the summer.
No. I have to start winning on a regular basis. Otherwise, it's going to be done in the summer for sure.
Yeah, 39th. Oh, yeah, like this could be over 3 weeks from now.
Well, no, because we bet every 2, so it's going to be. You could probably you could take it in 4 episodes.
Okay, that's good. Okay, I respect that. 3 points.
All right.
4250 on SEP futures, one touch, June 29th special settlement.
Lena,
all right.
Save us. No stupid questions.
You got to put on the... Okay.
I like how Lena doesn't tell us.
Hi,
she
Lena.
just jumps on, springs it on us. She's good.
Well, because if I told you, then you guys would just...
No, it's good. You did it right.
Go ahead and do it. Okay, so first question. Hi, Lena, Patrick, and Kevin. Thank you for the amazing shows over the years. After months of inertly disagreeing with him, I'll admit that Kevin was 100% right on the fact that there were too many bears and that both the economy and the market would prove more resilient than expected. He also said it would be a boring year, and here we are with the VIX at the lows. This is written after listening to the 2nd of June episode. Hats off to him for being right on both calls and having stuck to and discussed his view in the true spirit of the show. He didn't even take a victory lap about it in the last.
I did not choose this one. Patrick and Lena.
What, you got
very kind of you guys to choose this one. I have plenty of wrong ones though that I can tell him that he's more than happy to do
if you want.
And Patrick will send him the list if he's interested.
So I hope I'm not angering the market gods against him by pointing this out. Fingers crossed he's still right by the next show and his question makes it. Rather than ask any of my questions, I think what I should really do is show some humility, ask him what he thinks is next for the markets. Ooh. He seems to be on to something I don't see. Maybe also because I'm not a macro tourist reader. Love everyone's spirit. Cheers from London.
He doesn't want to know my opinion of what's next. He wants to know yours. All right, you do it, buddy.
Well, I don't know. That's a tough question. There's a lot of things that could potentially happen. I am a little scared about how quickly we've shifted into people getting bullish. So I am aware when Patrick shows his greed has gone to 80% that it's happening.
But that's just in CNN executives.
Right. Just the greed. And as much as I feel like I'm right, I feel like I was right for the wrong reasons. That the market didn't, like if you'd said, how was this going to play out? I would have never said the top 7 stocks were going to rocket straight up. Like I just never would have imagined that
you were right while you were so wrong on the fangs.
Yeah. In the spirit of true humility, I'll say that I was completely wrong about the reason that it went up. I do think, one second, I got the dogs. Can you just pause it here? I'll be right back. Okay, guys? Guys.
Enough. Cut it out.
At least he's not throwing a slipper at them.
You can choose to edit or do whatever you want there. So in terms of what I think next, I've kind of gone over it with Patrick when we talked about it in the markets, but I really think that this 43.20 strike on the JP Morgan whale is going to prove larger, and all else being equal, unless something dramatic else happens, I think that there's a good chance that we just pin there for the rest of the like the last couple of weeks of June. And then from there, it ends up being a lot more difficult. What I'd really like to see, I'll tell you, instead of telling you what I think is going to happen, what I'd really like to see is I'd like to see it broaden out, and I'd like to see we get to a commodity rally. I'd like to see the stocks that did well in 2022 start to rally again. I'm worried that we're not going to.
What I'm going to do is I'm going to just say one thing. The market loves to cause pain, and it seeks to find the pain trades and make fools as many people as possible. And so, to me, the fact that so many people are being forced to buy a market they don't like, the market forcing them back out of the market is like a perfect pain trade. Yeah. So I think that pinning the market sideways is letting them off the hook too much. I think there's room for volatility. Anyway.
Well, can I just say one thing about that, Patrick? I completely agree. And for those who don't understand that in terms of on an institutional level, I've heard stories of folks that are like value managers that are very kind of conservative, great investors that buy, stocks with high margins of safety, and they're looking at this AI crap and they're saying, I just got to buy it. And it's just the pain of them not participating is huge. And even though you might say, well, they're not really short, they are short because everybody else is long and the stuff that's going up is causing a problem. And so, Patrick, to your point, what I'm hoping is that we get a correction in the 7 and that money goes into the 493 or even better, the 1,993. All right, next question.
All right.
Next question. Hello, love the show. The shorter episodes are a great addition. We keep hearing about how most retail traders lose money over time. This is not necessarily useful information. There's a spectrum between average Reddit ape and Stan Druckenmiller, and the sheer mass of apes bring down the average performance. Do you have any intuition about the percentage of traders who would survive over long periods of time? Do you know of credible information about performance distribution by deciles? Over and out from Lake Wobegon.
You don't,
Kev. What?
I don't know. Like
listen,
guess.
I'll tell you this.
He's asking us for actual information, like data.
No, I don't know the stats, but I do know this. Okay, it's really hard to compare retail traders to professionals because far too many retail traders use the markets to gamble. They use the markets as a casino. They go in there trying to swing for the fences, taking crazy risks, and
that's a great point.
A lot of professionals don't do that. And so the thing is that you'd have to be able to create a statistic that actually compares retail traders that are taking their investing seriously versus those that are a basket into the same basket that are using it for the casino.
That's a great point, Patrick. It really
right?
is. Like, and obviously nobody's going to have done that.
No, so the point is that in order to compare professionals to retail, you'd have to basket of retail traders that are being serious about the way they're approaching their investing versus that of those gamblers.
And the last thing I'll say, and I've said this before, it has never been better for a retail trader to go and to beat the professionals.
Absolutely.
Commissions are zero. You have places like Patrick's Big Picture Trading that'll go and like teach
look
you
at the
about
shameless
stuff.
plug.
I figured after you were so nice and put that last, you guys picked that email. I feel like I have to say something nice now. In all serious, jokes kidding aside, it's the amount of information that gets spread on Twitter and via other messaging is great. And most importantly, and this is missed way too many times, the retail trader can sit it out. And the professional is the one that is forced to go out and buy NVIDIA 35 times because his peers have already bought it at 20 times.
Yeah. Yeah, retail traders can play their own playbook.
They can bench against what they want, not some arbitrary benchmark that has got too much of these 7 names in it.
There you go. All right, Lena, last question.
So last question. Hey guys, longtime listener here and hands down to the funny yet intelligent trading show ever. I have a simple but technical question that's been bothering me forever. So in the portfolio, there's long-term positions and short-term ones. How do I keep them from netting each other? Say I have long-term QQQ positions, but short-term I want to trade a long IWM short QQQ pair. In the trading system, it'll automatically sell my long-term Q positions and it's hard for me to track. I feel like there's an obvious solution, but I haven't figured it out. Thanks and keep up the good work.
Do you have
know what?
Because this is a great question.
No, you need to partition your accounts. Like you need to have multiple accounts, one that's long term and one that's short term. Like the problem.
But you don't actually need to partition it. You need to partition your accounting.
No, because the thing is, if you do it in the same account, it's creating a tax disposition for you, bud.
Oh, okay.
Like
so I'm not going to give any tax advice.
I know, but I'm just saying. Like let's say your long term position on your Qs, you've been in for the last 2 years.
But are you allowed to sell something on a short term basis and not
all I'm saying is there's got to be a way you can't, because the moment you do it in the account and it physically you can't go long and short. Well, what you almost need to do is you have to almost be long term long the Qs and then short another vehicle to get your NASDAQ downside exposure.
Okay, so I'm not going to talk about tax. I don't think we should talk about tax. Go visit your
No,
tax
I'm not
guy.
talking about tax.
But
I'm just saying you use another vehicle.
Sure, and that's
that
a
is
way you
not
can do
the
it.
actual QQQ to get your downside exposure on the NASDAQ. Whether you use the NASDAQ futures or whether you use one of the tech ETFs like what is that, XLF? Oh, not XL. Yeah, what's the one for the tech names?
I think it's
anyway.
Oh no, is
yeah,
it?
But whatever
K.
whatever
No,
it
K.
is.
Sorry, K. XLK.
Yeah, XLK. But the point is, you'd have to use something that tracks the Qs, and then you don't think anyway.
But then you got capital as a millionaire. I think that if I interpret this question correct, it's more like how do you keep track of all your positions, because you might be like long IWM, short QQQs, and then another trade you go long QQQs for a day trade, and then you go look at your account and all your is showing as a long IWM, and you're like, wait, and stuff. So for me, I feel like you do need to track it. I like to make quote unquote strategy buckets. Like you could do it in Excel. The trouble about Excel is after a lot of trades, it's difficult to track your P&L. And I eventually just wrote my own database kind of thing because ultimately that's the problem. But you could go, I think there's a variety of different kind of portfolio management softwares on the web. Go use that. And all I would do is I would assign a different strategy to it. So I would have IWM, QQQ pair. And then in another strategy, I would have QQQ day trading. And so on the one strategy, you'd show the long of the IWM and the short of the QQQs. And then the other strategy, you show long QQQs, but when you actually went and looked at your account, it would be flat Qs. So that would be my advice.
Okay. So, Lena, where can they submit their questions?
So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
So thanks for tuning into the Market Huddle. We appreciate you spending some time with us. You know to go and check us out on Twitter. You get to chat with Lena, which is way better than Patrick and myself. You can go check us on all the networks. You know the deal there. Patrick, where can they find you?
You can find me at bigpicturetrading.com and or on Twitter. You can follow me at Patrick Surasna. Kev, where can they follow you, buddy?
They go check out my website at themacrotourist.com. And if you want to go and chat with us, you can go themacrotourist.com/chat. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. Now stick around for the after show.
All right. Well, let me rate this beer. Putting it in the category of English pale ales, this is one of the better ones that I've tried, bud.
It looked good.
Yeah, I'm gonna give it an 8.2.
It was one of the better ones that you've tried, and you're giving it an 8.2?
Well, no, because I'm not like you. You're the one that goes gives everything a freaking 9. You know what? 9 is special.
In the old days, you used to get mad at me because I used to give 3s and 2s.
Well, okay, because we use the lower boundary of 5. It's pretty much dog shit piss if you're going under 5.
Oh my goodness.
Honestly, anyway, I this is a well above an average pale ale. 8.2, I think, is a fair score for a good beer.
Okay, fair enough.
Yeah.
All right.
So, how's everything going?
I'm good. How about you guys?
That's all good. It's I'm out in Mexico, and it
tough.
is so stupidly hot. Honestly, it feels like with the Humidex, I think it feels like 40.
Yeah.
And it's like the air is so thick, it feels like you're smelling boiled potatoes. It's like a thick, starchy.
I have one
It's
story
like
about
you have to take a shower 3 times a day.
I have one
you
story.
want to 5 times.
I have one story about Mrs. Macro Tourist. I don't think she'd mind us be sharing it with you. When we were young, we were dating, and my dad had this one of those shitty little timeshare things that you could trade points or whatever. So somehow I got a week free in Mexico. And so we went to Mexico, and it was like you landed the plane, and you walked right out onto the tarmac, and my wife's hair just went boom, like Monica from Friends.
Oh.
Is it Monica? Yeah, it's Monica. It just boom
Monica.
because of all the humidity and stuff. It was literally, you could see it happening. And we would walk to town, and we would fight until we got into the air conditioning place, and then go, hey, what were we fighting about? I'm not made for
I would
humidity.
be very irritable
Humidity
too if
is
it was
brutal.
that hot.
Oh.
Yeah.
Yeah.
I'm not a fan.
All right.
No one likes that.
I guess you're right. But I'm not going to feel that bad for you, Patrick. You get to go hang by the beach, even if it is 40 degrees with Humidex.
Yeah, there's no hanging out outside.
He's in an air-conditioned place in Mexico.
Is it that bad? You don't even want to go out?
Well, I'm working during the day, so it doesn't matter, right?
Is it night? Is it nice at night?
Well, I don't know. You call 27 nice?
Oh god.
I don't know. It's
that's
pretty
still
good.
really hot.
Is it okay? So that's just because it's summer.
27 with humidity is probably still feels like 35.
It's pretty sticky. You pretty much you have to have a light shirt on with shorts all the time.
Oh gosh, I just got an image of Patrick wearing a mesh shirt on the beach.
Speedo.
Oh no.
It just gets better and better.
No, stop it, both of you. Anyway, Kev, this is where you ask what you guys been watching.
You guys been watching anything good?
No.
I don't have anything to add either. I guess it's just going to be. You know what? We went long in talking charts anyway, so we'll just call it a day.
So we'll wrap it.
Oh, no. I have forgotten again. We keep forgetting
almost.
Jim Leitner's
Contest.
We're on top of it. We finally got around to it. I do apologize. We're going to be sending out the winners. We'll be letting them know in the next couple of weeks, and you will be getting your dinner or meeting with Jim Leitner. So thank you for everyone that responded. We're going to go figure out who won by the order it came in, and we're going to assign winners. And so watch your email. If you were the winner, you will be getting to you will know shortly. Not actually shortly. In the next week or two.
It's on its way.
There was some interesting people's answers. There was some strange ones. But I should expect nothing less from our listeners. So there's absolutely nothing. Nobody's seen a movie. Nothing.
No, I just came back from Portugal, so I haven't been watching anything.
Well, okay, I'll talk about something then. I'm going to see Somersault tonight. It's I was telling Lena earlier
What is that?
It's a band. My daughters are taking me for an early Father's Day. Long story, but and we're gonna go, and I am probably gonna be at least 20 years older than the oldest person there. I'm not kidding you.
Sounds like they just wanted a chaperone or a ride.
I will call it. There is going to be a gap. There's going to be a gap scenario between the oldest versus me. But I like it. I like going out and feeling young, and going to go out to this band. Hanging out with the kids. See what the kids are talking about. See what them kids are talking about.
Bring your credit card. The kids all like when you buy the drinks.
Secrets
So
out.
that is what I've got going. So I will report back and tell you how the kids' music is. It's got a groovy beat. I can dance to it. I'm giving it a 7. Thanks, Casey Kasem. Okay, have a great week. We'll see you guys in a couple of weeks. And
all right.
Good luck, Patrick, on your bets.
All right. All right. Have a good one, everyone.
Bye, everyone.